Very good morning to everyone. In previous class, we have seen about different asset classification. So different asset classes like various investment avenue are grouped into three categories, and we might be seeing about those are being called as an asset classes also. And this grouping of investment, we might be seen familiar with the asset category. And I said about real estate, commodities, equity, and fixed income. And when we see about these three categories, and we have gone for one diagram also how real estate is safety wise, liquidity wise, return and reward. And when it's come for commodity market, safety is very less, liquidity also very less, but when it's come for risk and reward is more. Equity, I said about safety is very less, liquidity is converted anytime, return is high, reward is a mixture of risk and reward. Then fixed income always yield safety, liquidity, return is less compared to rest of the avenue, but reward also can be seen comparatively rest of the investment it is very less. So coming to the real estate, here real estate is considered as the most important, the popular among the all the estate, and it is classified in form of a different way where you have a different classification in form of a category. When it's come for category, it is popularly as I said reason not to relate it to any type of investment, or this should not be considered as an investment also. Sometimes selling the same may be have a negative impact on the lifestyle too. So when I talk about real estate here, real estate might be one type of investment, but selling of the same, if they have an impact on your lifestyle with the negative, then real estate could be further classified as a residential real estate, land, commercial real estate. So this asset is categorized based on the location, right? Asset category, real estate might be in form of a category like location, which is important factor. Then it is not a divisible asset. One can invest in physical real estate. Apart from capital appreciation, it also generates current income, right? Then you have a commodity. When we see commodity, this is another asset category where people at large are familiar with the various way. Regular basis, people consume many commodity, agriculture commodity like spices or petroleum products like petrol, diesel, metals like gold and silver. Possible to invest in most of these. Many of these either perishable, hence cannot be stored for the long, or storage of the same could not take a lot of space. So creating different kind of difficulties are also can be seen at a commodity market. Then commodity derivative available on many commodity. It may not be wise to call this investment. Two reasons, like these are leverage contract, can take leverage exposure with a small money, making highly risk. Normally short term contracts, whereas the investor need a more longer period. Then when it's come for the third one, we are into about fixed income. When someone borrow money, one has to return the principal borrowed to the lender, the future, and there could be also some interest payable on amount borrowed. There are various forms of borrowing, some which are through marketable instrument like bonds and debenture, right? Then there are risks too. Bonds are generally considered safer than equity. These are not totally free from risk. This risk will be discussed on the later on. But the fourth one is the equity. So in this slide you might be seeing investment avenue is classified into different asset category. One is equity. When we talk about equity, this is the owner's capital in a business. Someone who buys shares in a company become a part of the owner of this business, and this is risk capital, since the owner earning from business are linked to the fortunes and the risk of the business. When one buys shares of the company through secondary market, share price go to high or low in comparison to fair price, or equity investing has generated return in excess of inflation, which means purchasing power of one's money has increased over of the year. It has also delivered the high return than other investment avenue. Most of the time, if one consider long investment period, other may not also. So this is the category what we have seen in the last slide in the previous class about the four important classes of assets. One is about equity, one is commodity, real estate, then one is a fixed income. So out of four category, I said that fixed income has a very less risk, but when it's come for return reward also it is comparatively lesser than the other kind of a class of assets. So going to this slide, investment avenue classified into different category, and this category has a different types of fixed income in form of equity. So here there are two types of differentiation under this category. One is about equity, one is about fixed income. Now equity is like a blue chip company, mid size, small size, then unlisted company, foreign stocks, equity mutual funds, exchange traded funds, index funds, Nifty, Sensex, Bank Nifty. All these are stock market equities. Okay, the first category is considered as a stock market investment category, stock market equities. The second side might be seen with the fixed income. When we see the fixed income like a fixed deposit with the bank, recurring deposit with the bank, endowment policies, money back policy, senior citizen savings schemes, company fixed deposit, debenture or bond. Now this is the first two classification, first two avenue which is classified under different asset category. One is form of equity, one is form of fixed income. Now equity, all these examples are in form of equity, and one is about fixed income. People invest under different category. So you have a equity mutual funds too here, equity mutual funds. So you will study very detailed about mutual fund. There are different variety of mutual fund, but you should know that under different avenue investment plan, it is classified under company wise, invest in the stock market, trading in the stock market, or in form of equity, especially Nifty, Sensex, Bank Nifty, they are the index funds. So there are fixed income where the previous slides shown about very risk and more risk, high risk or low risk, or in form of average liquidity, safety wise or return expected. This might be seen. When it's come for equity, I can classify when it's come for this class of equity. Here equity, blue chip or mid size, unlisted, foreign equity mutual fund, all these are safety wise for the investment. Somewhere it is moderated, less safety, liquidity anytime you can convert, risk is high, reward is a combination. It's a mixture of both. It's a high return or low return. But when it's come for fixed income, when you classify this category in fixed income, safety wise, liquidity wise, return wise, and the reward wise. Safety and liquidity wise, they are highly safer side, converted anytime, but compared to return and risk is less, reward also less. All this debenture bond, why? Because these are yielding fixed rate of return with the very less number of risk. Then real estate, infrastructure, commodity, which has been categorized here. Real estate, infrastructure, real estate mutual fund, hybrid asset classes, hybrid mutual fund. Then you have a commodity, gold, silver, gold fund, then other stamps, right? Now this is classified like a real estate has a less safety. Why? Because today's market, tomorrow market, no one can be predicted in what way market will go high and come low. And liquidity also, you can't convert if there is no buyer for real estate so easily. It cannot be converted into cash at any time. Then when it's come for return, 100% you wait for the longer period, there more return. Waiting period itself is a risk, and rewarding also 100% you have a high reward. Then when it's come for commodity market, here gold, silver funds or a kind of a stamps. Here the commodity market, safety wise they are less safer, liquidity also very less liquidable, but when it's come for risk and return is high, reward also high. Waiting period is important. Now coming to, after conclusion of all this basic introduction, one should know about what is all about this concept of mutual fund, role of mutual fund, where it stands for, how it should market, what is the more profitable mutual fund, how they are diversified, why they are called diversified funds, and mutual fund investment in what form, mutual fund in form of equity, in form of bond, in form of money market instrument or any other security. That's why you have a fund manager. Fund manager will look into all types of funds mobilization of money from investor to invest in different market or security. Now coming to this slide, concept and role of a mutual fund. A mutual fund is professionally managed investment vehicle, 100%. A mutual fund goes from one hand to another hand, and it is also called professionally managed investment vehicle. Practically, one does not invest in mutual fund, but investment through mutual fund. However, we hear about investing in mutual funds or investing in mutual fund schemes. That is fine for purpose of discussion. Technically, it is not correct. Mutual fund distributor, it is critical to understand difference between the two concepts. When someone says that one has invested in the mutual fund scheme, often scheme is perceived to be competing with the traditional instrument of investment. Equity share, debenture bonds. Reality is that one invests in these instruments through a mutual fund scheme. Other hand, through investment in mutual fund, investor can get access to equity, bonds, money market instruments and other securities. So many a time unavailable to them, available to professional fund management service offered by asset management company. So mutual fund is kind of a vehicle where form of a trust. It will form kind of a trust. So mutual fund is a vehicle of trust, mobilizing money of the investor to invest in different market and security. Started in form of investment objective. Investment in mutual fund, investor can get access to equity, bond, money, instruments. All these are classified by the fund manager. So fund manager will take the responsibility of managing such kind of funds, and will become more and more responsible to get to be invested. So here there are different classification, different types of investment take place, different perception on the mutual fund, how it is invested, and what are different types of mutual funds, and how this type of mutual fund schemes are benefiting and fulfilling the objective of the investor. So next you have a role of mutual funds. There are different category, different role stated on the objective. When we see this definition, overview of definition or in form of mutual fund, and I said that a mutual fund is type of a vehicle or instrumental vehicle where it will run the business in form of different avenue, in form of risk, return, in form of safety and security. So definition here it is said mutual fund is an investment vehicle to the pool money from multiple or multitude of people. It is a money of many, I can say, a funds which is created from many. It is not by single person. fund of many. It's a people's money end of the day. Multitude kind of people, investor like you and me investing in mutual fund. It uses the pool to purchase security like stocks, bonds, gold. The prices of security change. The mutual fund scheme makes it returns, which is turn investor return. Professional money manager with decades of experience manage each mutual fund. Take call on which security to buy, which to sell. So mutual fund itself, the fund manager itself take a call which to buy, which to sell, right? So mutual fund is managed in a manner, the constant manner which has an objective. Now if you see this slide, like one mutual fund, you have one investor, he pool his money together with the fund manager. Later on, fund manager choose security where to invest in. Every mutual fund there is a fund manager, and this fund manager act as a role of a middleman or the broker or the agent who can guide about a multiple source of investment. And this fund manager takes such kind of a classification how and why to invest now and then. So he chooses security to invest in. Later on, this fund manager invests in some kind of security. It can be the security market. I said about the commodities in form of different types of mutual fund or equity or real estate or in form of fixed income. Now this security will yield or generate the return, right? So based on the fund manager, what he has chosen about investment in form of securities, he choose one particular security and start investing there, and that security will yield some kind of a return, and the return is passed to investor once again. So this is the wheel what we can see, starting from the investor ending also with the investor only, and it has multiple objectives also. Investment under multiple objective, classified in different form, different source of income, where the money invested in one particular platform is pouring into different category, diversified into different category, into multiple basket, and which will yield or fetch with the good return. So this is how it is classified in different part of investment plan, and this investment plan always categorize or classify into different mutual fund schemes and securities. So investor always would like to know about what is my pool or money basket where I can invest. I'll just go for fund manager. Fund management will be very clear that choosing of security and investing in what type of securities. There are multiple avenue where you can invest in form of mutual fund. In mutual fund, what category? SIP with risk associated, non-risk associated, or with kind of a market or market link plans, or without market link plans. When it's come for market link plan, always it will yield high return. Why? Because the market is very risky. Boom will take place at any time. Increase or decrease in the price, fluctuation, variation of the prices will take place every instant time. So here you might invest in form of market linked or without market link. Without market link will yield return, but not that high like market linked returns. So here investor fund management investing in the security, getting a return, passing down of this investor money once again with the return, 100% it is required. And mutual fund always it is all, that's why I said that is a pool of bunch of people, and it is a kind of a pool of security, stock, bonds and the gold, and there are different categories classified money which is multiplied from different pool of segments. So it is a pool of many, money of many, investment made by many investors like you and me. And this category talks about how being it is invested and why it is being invested and how long it can be invested and how return can be expected in the futures. So this is a category wherever you go, whatever classifications there in the mutual fund just go for identifying good security. Though you can cut the channel of the fund manager, directly investor to the security, security return to investor back. But today it is possible because of the online information you have. In online, various apps have been uploaded. Through app you have a security enough to get into this kind of investment, where you get a different idea. Many people just cut down the manager cost, and they choose directly in form of security, investing in form of security of the company. Based on the performance of the company, they just go for identifying the company, investing in form of security, and they get return. But many of the time the fund manager, if you go for the mutual fund offices, fund manager will help you to choose the best security which have been yielded from many number of years. So I'll stop here. We'll see remaining classes in next slide in the coming days. Thank you all.